You ever look at a company's price tag and just think, how in the world did they land on that number? Well, today, we're pulling back the curtain on exactly that. We're going to dive into a tale of three completely different worlds of valuation, each with its own special way of figuring out a company's price. Let's get into it.
It's a real puzzle, isn't it? I mean, you've got a tech startup, it's not making a dime in profit, and somehow it's valued in the billions. And then you've got your local business, profitable for decades, and it's worth just a tiny fraction of that. So what gives?
Exactly. On one hand, you have the rocket ship, right? It's all about that explosive future growth, that massive potential. And on the other, you've got this steady, predictable bar chart. Just solid, reliable earnings. They basically live in different universes, so it makes sense that you can't price them the same way. And that's really the secret right there. There is no single magic formula. Valuing a company is kind of like being a mechanic. You wouldn't use the same tool on a Formula One engine that you'd use on a lawnmower. You need a different toolkit for every job. So today, we're going to open up the three main toolkits. All right, let's jump into our first world, which is easily the riskiest and, let's be honest, the most exciting, the startup. In this world, the past means nothing. It's all one big bet on what the future holds. You see, this is why all the old school valuation methods just completely fall apart with startups. How can you analyze profits when there aren't any? How can you look at a company's history when it barely has one? You can't. So instead, you're forced to look at pure, raw potential, which, comes with a ton of risk. So, to get around this, investors came up with something called the venture capital method or the VC method. And it's smart. Instead of asking what a startup is worth today, they ask a totally different question. What could we sell this thing for in, say, 5 or 10 years? It's all about that future payday, the big exit. So here's the basic recipe. First, you dream big. You estimate what this company could be sold for down the road. Then, and this is crucial, you decide on the massive return you need to make this insane risk worthwhile. We're talking returns of 30, 40, even 60% a year. Finally, you take that target and you work backwards to figure out what you should pay for it right now. Let's make this real for a second. Think about Uber in its early days. It was losing an absolutely staggering amount of money. But investors weren't buying a taxi company. They were betting that Uber could one day own the entire concept of personal transportation. Or think about a biotech firm that has no revenue, no product. Its value is purely a bet on whether its experimental drug will pass clinical trials and change the world. In both cases, you're not buying a business, you're buying a dream. Okay, so let's leave that world of dreams and come back down to earth. We're entering a world of cold, hard data. The publicly listed company, the giant. Now, this is the total opposite of a startup. Public companies have years and years of financials that have been checked by auditors, they're usually profitable, and, importantly, they have a stock price that's updating by the second. But the best part? There are tons of other public companies just like them that you can compare them to. Because you have all this data, the main tool is what's called relative valuation. It's a fancy way of saying you compare a company to its peers using these financial ratios, or multiples. And this table shows you the greatest hits. For a really stable, profitable company like Coca-Cola, you use the price to earnings, or PE ratio. For a fast-growing company that isn't quite profitable yet, think Amazon in the early days, you can use price to sales. And for a business like a big bank where its assets are its business, you look at its price to book value. Different tools for different jobs. Now, this whole approach really hinges on one big assumption, that the market overall is pretty smart. You're basically trusting that the prices of all those other similar companies give you a solid, reliable benchmark for the one you're looking at. Okay, on to our third and final world. These companies, they're not startups with big dreams, and they're not giants on the stock market. They're the established private businesses, the real cash machines of the economy. And the go-to tool here, the workhorse, is the EBITDA multiple. Now, EBITDA is a mouthful, but it's just a way to measure a company's core profitability, what the engine is really producing. You just take that number and multiply it by a certain factor based on its industry and how stable it is. It's a direct measure of its power to generate cash. So let's check out a real-world example. We've got a successful metal fabrication company. The owner's ready to retire, and this business has almost doubled in the last 4 years. It's doing great. And this is the number that everybody cares about. Its EBITDA for the most recent year was $3.2 million. And because the business is growing so fast, any potential buyer is going to base their offer on its latest, strongest year of performance. So, what's it worth? Well, a buyer is going to look at those earnings and apply a multiple. For a strong company in this industry, that multiple might be somewhere between 5.5 and 6 times its annual EBITDA. And then you just do the simple math. 3.2 million times 5.5 gets you 16.7 million. Times 6 gets you 18.3 million. And just like that, you've got your price range. That's where the negotiation for the sale of the business will start.
But what about when a business is headed in the other direction? Now we've got a print marketing company. Its world is changing. Customers are going digital, and sadly, its business is shrinking. You see, the logic is exactly the same, but the numbers are different. Because the business is struggling and shrinking, buyers are way more cautious. So they'll apply a much lower multiple to those same earnings, maybe 4 to 4.5 times. More risk means you pay less for every dollar of profit. Makes sense, right? Phew. Okay, so we have traveled through 3 very different worlds, each with its own way of talking about value. So let's tie this all together and find that one single idea that connects everything.
And here it is. This is that aha moment. It all comes down to picking the right tool for the job. For a startup, you're measuring its future potential. For a public company, you're measuring its price against all its competitors. And for a private business, you're measuring the actual cash it can put into your pocket right here, right now. So why are the tools so different? Well, it boils down to this. It's all about how much risk you're taking, how uncertain the future is, and how much good, reliable information you actually have to work with. The less info and the more risk you have, the more you have to rely on a good story about the future. Let's end on this because I think it sums it all up perfectly. Every valuation method, no matter how complex, is really just trying to answer one simple question. For a startup, it's what could this thing become? For a public company, it's what is this worth relative to everything else? And for that private business, it's if I buy this, how much income do I get? At the end of the day, the price tag isn't just about the numbers. It's about knowing which question you're actually trying to answer.